When investors lose money, we often think it's because they've invested in the wrong assets. As you'll soon find out, investing in quality assets may not be enough to prevent those pesky losses. In fact, these losses can be the result of the choices you made outside the stock market. So, here are 4 pre-investment decisions that can cause you to lose money as an investor. There are many things you can do without a plan, but bringing this attitude to investing can cost you dearly. Without a plan, you are likely to succumb to the recklessness of FOMO or fall prey to sensationalized forward headlines that typically lead to poor investment decisions. Having a plan brings clarity of purpose and reduces the chances of reactive investing, especially during times of heart-pounding market volatility. Some of the questions you might want to answer in your investment plan are: what's my investment goal? How will I achieve it? What's my time frame? How much can I afford to invest and how often? Do I want to invest in individual stocks, funds, or both? What criteria will I use for selecting individual stocks to invest in? What's my risk tolerance? What do I do in different market conditions, bull or bear market? And other questions relevant to your unique situation. While having a plan is essential, it might not be enough to stop you from racking up preventable losses, especially if you face the consequences of the next decision. There is a reason why people toss aside whatever they are holding when fleeing from danger. This is because you are only as fast as the baggage you are carrying allows you. It's the same idea with investing. Every debt you take on reduces your disposable income since it must be paid back with future paychecks. This is money that would have gone towards investing. While no one expects you to pay off your mortgage or student loan overnight, the typical culprits are your high interest rate loans, such as credit cards. With interest rates of 21% or more, you are looking at an interest cost higher than the typical market return of 9%. So, if you choose to invest without first settling these types of loans, you are likely to encounter these 3 scenarios. Firstly, even if you achieve the typical market return, you still end up with a net loss of 12%. Secondly, the interest cost on your debt is guaranteed, but your investment return is not. In fact, your investment might even yield a loss in addition to the borrowing cost. This means you are losing money on both fronts. Thirdly, you might eventually realize your mistake and decide to reverse course by liquidating your assets to pay off your credit card debts. The problem here is, at this point, you might be selling at a loss. In a nutshell, before embarking on your investment journey, shed the baggage of high-interest loans. Apple is known for many things: the most valuable brand in the world, the business with the largest market capitalization, and a company that makes you feel good paying a lot of money for its products. One thing that's not talked about enough is that Apple has tens of millions of dollars in equity capital and reserves. That's a huge reason why businesses with such strong financial footing are able to weather the storm during periods of economic downturn, while those without a financial cushion go under. The same principle applies to personal finance and the importance of an emergency fund. Interestingly, when we think of an emergency fund, what usually comes to mind is taking care of our urgent financial needs. But if you are an investor, your emergency fund does more than that. It can also protect your investments. Imagine facing an urgent financial need without an emergency fund. Your first instinct might be to reach for your credit card. As we discussed earlier, this has some consequences, particularly if you don't clear the balance on time. But that's not all. What if you have no access to credit? Then, you might be forced to liquidate part or all of your investments, and that's when things can get tricky. I'm sure you know the drill by now. What happens when you have to sell your investments at a loss? As you can see, an emergency fund is not just a buffer for unexpected expenses, it can also protect your investments. Between November and December 2021, many stocks reached their all-time highs. For instance, between May 21 and November 4, 2021, Tesla stock surged by almost 110%. I remember a friend telling me how he made over $20,000 from his Tesla stocks on August 25, the wildest day of the rally. The FOMO at the time was palpable. So, it's understandable why anyone would have been tempted to get in on the action. But this is the trap many investors fall into, trying to make a quick profit, especially by investing the money they need in the short term. If you invested $50,000 at the peak price on the 4th, in just 6 weeks, you would have lost 24% of your investment. But if you decide to ride it out, God help you if you had an urgent need for your money on January 6, 2023, when the stock price had fallen by 72%. That means in just over a year, you would have lost a staggering $36,000. Can Tesla stock reach a new all-time high? Absolutely. But when? Nobody knows. The point is, if you don't want to get caught up in a sell-off or a prolonged bear market, don't invest the money you need in the short term. Investing is not all about choosing the right assets. Your choices before you even start can determine your financial fate. These choices can haunt you in different ways. They can force you to make decisions you know would hurt your finances, like selling your investments at a loss. Don't let your pre-investment decisions sabotage your financial goals. Consider doing the following. 1. Do your research, write a clear plan, and stick to it. 2. Get rid of high interest rate loans. 3. Have a healthy financial cushion. And 4. Avoid investing the money you need in the short term. Hope you found this video helpful. Don't forget to like it and subscribe to the channel for more. Thanks for watching. I'll see you in the next video.